Hey everybody, what is up? Welcome back to Final Trade. It's the fourth quarter of the year, and so since people are starting to think a little bit about final financial and tax preparations for the tax year, I'm beginning to see in the comments sections of financial press articles the occasional mention of tax loss harvesting, and I will just come out right from the beginning and I will say, bottom line up front, tax loss harvesting is for suckers. You should not be doing it. Okay, but I will give you the reasons too. The idea of tax loss harvesting is that you've had some gains from various assets you've bought and sold over the course of the year, and you're going to have to pay capital gains taxes on those gains. But you probably also have some assets that have performed badly that you have not sold. Tax loss harvesting is when you go in and you sell those poor performing assets in order to offset some of the gains to lower the amount of taxes that you have to pay. Here's the problem. Okay, let's say you have some great amount of capital gains from selling assets for more than you bought them for, and you're going to potentially have to pay I believe right now it's 15% is the lower bracket for capital gains, long-term capital gains in the US. You're going to have to pay 15%, and you don't want to pay that. And so let's say you have some bad investments and they're way down, and if you sell them, you can deduct another $1,000 of losses from those investments against the capital gains. So you lock in the losses of that $1,000 loss of an asset you were holding, and that prevents you from having to pay $150 in capital gains. So you've paid $1,000 to save $150. And now if you say, oh, but, that $1,000 was never coming back. It was a terrible investment and, it was never going to recover. That's your other problem. You shouldn't be buying crap investments that go down like that. And if you buy an investment and it does go down, it should be something you're willing to ride out over time. If you buy an investment and it's not something you're willing to hold for the long term and really make great profit off of over a long time, you shouldn't be buying it in the first place. You should be buying great assets at a good price. That's one of the things that I really agree with Warren Buffett on. Warren Buffett's a mixed bag. Some of his advice is really good. Some of it's not. Some of his takes are good. Some of them are not, But he is correct that it's better to buy a great asset at a good price than a good asset at a great price. And so something I talk about a lot is your long-term theses. What are your big ideas that you think will stand the test of time and still be correct at the end of your life? And that's how you should choose your investments. My personal long-term thesis is markets will continue to grow. Birth rates for the whole world are still on the rise. And so there will be increasing sized markets for a long time. Even after birth rates start to turn negative in aggregate for the whole world, productivity will still continue to increase. So you will still have time after that in which markets continue to expand. And if markets are continuing to expand, technology continues to progress, then essentially most assets will go up in value over time. And that's one of my biggest long-term theses. That's why I always say the future is always bullish. And so with that in mind, I think you need to hold assets for the long term because that's how you profit the most. You don't profit the most by trading in and out of something over and over or expecting to hold something for a short amount of time and flip it. Once in a while, you get lucky on things like that. But by and large, most of us cannot consistently beat the long-term market by doing things like that. So the smartest way to invest is to buy great assets at a good price, hold them for the long term. Now, if you're not buying great assets to start with and they're things that crash down, well, start buying great assets instead. Reevaluate your long-term theses. Think long and hard about the biggest ideas that you think will stand the test of time. And if you're emotionally selling great assets because they're temporarily down, that's something else you have to overcome as an investor. And again, I've known other investors in my life who will have, good sized stakes in great blue chip companies, and they sell them because they go down 3% on one day. And somehow they can't see far enough into the future to think, oh, yeah, that was Coca-Cola. Of course it'll be fine. Yeah, that was Walmart. Of course it'll be fine. You know, a couple years ago, Walmart and Target both posted some really bad results on the same quarter, and they both got hit for something like 15 or 20% stock price decline. And I went in and I bought. And, you know, they've done great since then. Target hasn't done as well as Walmart, but it's done really well since then. It was irrational for the market to treat it that way at that time. And so you have to think, don't be emotional. Don't think, well, something's down a little bit, I can tax loss harvest it. And the amount of money that you lock in the loss of by selling the asset low is greater than what you're saving in taxes. It's for suckers, and it's a dumb idea. So if you find yourself in the situation where you're saying, I need to tax loss harvest because, you know, I've had some winners and I've had some losers and I don't want to pay that much in tax, you need to reevaluate how you're deciding what to invest in the first place. And I can tell you the number of times in a year that I sell an asset in the stock market, it's low single digits. I mean, it's rare that I sell something, but I've come to a point in my life where, you know, I only buy great assets at good prices, and I plan to hold them for a long, long time. And so I don't panic sell. I rarely sell at all when it comes to stocks because I've chosen well. And if something goes down 5% in a day, oh, maybe I'll buy a little more with some extra cash that's kicking around in the brokerage. If it goes down 15%, well, is it a cyclical industry that just does that from time to time? You know, is the whole economy getting battered that day? No matter what, I'll seek to understand it, but I'm not going to panic sell over a couple days of poor performance. And I'm certainly not going to say, well, I need to lock in a big loss so that I can stop myself from having to pay a small tax bill. Stop doing that. And don't lock in your losses like that. You're throwing money away to claw back pennies. I feel kind of bad making videos like this sometimes because some of these topics just, to me, they feel kind of like, duh. Like, duh, we shouldn't panic sell and lock in losses. Duh, we shouldn't invest in things that we don't have strong long-term conviction in. And so sometimes it's kind of hard for me to make a video like this and talk about something where, to me, it seems so apparent. But it's that time of year again, the last quarter. People in the forums on financial press sites will start mentioning it and acting like they're really smart because they're tax loss harvesting. They're deciding to lose a lot of money in order to prevent losing just a little bit. Make better investment decisions. Reevaluate your long-term theses if you think that's necessary. If you've never thought about long-term theses, spend a couple months thinking about it. Just in the back of your mind from time to time, kick it around and think, what are the biggest ideas that are going to shape the world for the rest of my natural life? And how will that affect the financial side of the world? Try to figure those things out or jump off from mine. Maybe you agree with mine, maybe you don't. They've served me well so far. But stop it with tax loss harvesting. It's for suckers. Thanks to everyone who makes this content possible, especially my very generous supporters on Patreon. Like, comment, share, and subscribe, and join me on Final Trade.